Tom, Investment News has been a partner with the Lipper Awards for over a decade. We're excited to do it again. So before we start talking about the awards themselves and some of the trends for 2023 and 2024, can you tell me about the evolution of the Lipper Awards?
Yeah, actually, they started about 31 years ago with a group called BOP. It's out of Switzerland. And the first time, though, we ever had an award here in the United States was actually on this day. So it was March 13th, 2003, when we had our first fund awards. So the evolution has actually grown over the days.
And can you talk about the methodology for the awards? Because when someone goes home with a trophy, a lot of people want to know, did you really deserve it? How do they get those awards?
So I think that's probably one of the most important questions we can ask. What we're taking a look at is what we want to do is to identify ways to find funds that fit investors' portfolios. And also, they're advocates, right? So they can go out there. We created a thing called Lipper Leaders. We have 5 different Lipper Leaders. We have a Lipper Leader for expenses, for taxes, for preservation of capital, and total return. But the one we are focusing on tonight is going to be our Lipper Leader for consistent return. And that's a risk-adjusted return measure.
And what's the time frame for when these funds are measured? Because 2023, that was a great year for stocks. The S&P was up at 24%. Year before, 2022, not so good. So what's the time frame?
So that's really probably the big catch here, too. And I think one of the strong points, risk-adjusted return, as we talked about, but we measure this, and these are done on a monthly basis, but we measure them over 3, 5, and/or 10-year periods of time. And what's unique about this risk-adjusted return measure is it's not the old Sharpe ratio where they actually used to one period and in period and then look at standard deviation. We actually look at multiple time periods within the 3-year time period. And not only that, but we take a look at these periods, and we take a look at these periods on a rolling basis over these periods that I was talking about, and we take a look at both top performance and downside performance. And we actually weigh downside performance more. So people are generally risk averse. And this is what we're trying to capture in this. So the 3, 5, and 10, and we're doing it in multi-periods within those time periods. And then we are punishing, if you will, downside performance. So we end up with really good risk-adjusted returns.
One of the things that worries investors and advisors when it comes to mutual funds is style drift. Can you address that?
Yeah, and that's something that we actually keep a very, and it's a great question for this very simple reason. Our classifications are maintained virtually twice a year. We take a look at the classifications to make sure the fund fits that classification. You call yourself large cap growth, you got to stay at large cap growth. And the reason is it wouldn't be fair to have somebody moving out of this. So one of the things that we do with an expertise touch is we are actually looking on, again, very frequent basis, twice a year to make sure they fit. And remember, this is over 3, 5, and 10. And we've been doing this all this period for the last 50 years that we've been Lipper.
But how do you find the diamonds in the rough out there? Some of those funds which they may not have the branding as one of the larger ones might have.
And that's one of the benefits of the Lipper Fund Awards. So what we do is we break out groups. And so we actually have, so we were just talking about classification awards. What we have is a fund management group award. And what we do is we take a look at the size of the funds, overall assets under management, we put them into an array, and at the 85th percentile, we actually cut off the cutoff. And right now, this year, between a large group and a small group, so we can find those diamonds in the rough, we set it at $136.9 billion. So anybody $136.9 billion or below is considered a small fund family group. Anyone that's larger than that is a large fund family group. Well, that's a small group, by the way. A lot of assets under management, right, are being held by a good, small group of those fund families. Now, what's even more interesting is what we do is we take a look at this, and we have a system where we have asset classes that we're actually giving these awards for. Remember, we have the group awards, but what we do is we break those out into 3 primary groups: equities, fixed income, and then also mixed asset funds. And then we have a final one that is overall. So we have a large fund family winner for equity, mixed assets, fixed income. And then we do the same thing for small fund families, and it helps investors find those funds that fit.
When you look at mutual funds over the past 20 years, you've also seen the rise of ETFs and active ETFs. Can you talk about your thoughts just looking back over the last 20 years and seeing a lot of mutual fund flows move into ETFs?
In the last several years, we've actually seen a massive outflow out of actively managed funds. and into passively managed funds. They can be non-ETFs, by the way. But what we are seeing now is this new, they call them non-transparent ETFs, so they don't have to report on a daily basis. And I think this is a trend we'll continue to see. Active ETFs, I think, are here to stay, and we'll see some good competition coming into the market. So we have seen this change. I think it was a great change. If you're not keeping your eye on the market, if you're not really, interested in trying to get a few extra basis points out of every return you get, I think for somebody starting out, a good ETF is a great way to go. Active management does have a place in our portfolios.
And where do you see the Lipper Awards going over the next 20 years? I don't know if we're going to be around in 20 years, but hopefully we'll be around. But how do you see the Lipper Awards evolving?
I think this is an important tool. Remember I told you we have a toolkit, right? And it had all those 5 measures. Quick way for both the investor and also their advocates, whether it's a registered investment advisor, fund selector, whatever the case may be, they are going to be able to come into Lipper to actually do a good analysis, a good evaluation, and find funds that fit. And even if we're moving into this new ETF trend, they're not going to be completely ETFs, right? I mean, passively managed. I think there's always going to be a market for actively managed funds. And I think there's also going to be those investors that want to find a good passively managed funds. The idea, we meld all of these together to come up with that perfect portfolio that basically gets the best risk-adjusted return and then also is used to identify funds that fit our needs.
Aside from moving into ETFs, it seems as though people have also moved out of individual stocks. There was a time not too long ago where people were trading individual stocks, waiting for earnings, waiting for the whisper number after the bell. That really has gone away. Do you think that's a positive thing that people are getting away from individual stocks and into index or fund investing? Or do you think that people are leaving money on the table?
I think they might be advantageously leaving money on the table. And the reason I say it that way is because most people that are out there, you and I are in the business, we keep an eye, and every portfolio manager that's getting an award tonight is doing that as well. But I think that the ability to do the research and that type of stuff has actually caused a lot of people not to want to do it. They've seen a lot of different scams. They've buying at the top, selling at the bottom. And I think that's caused some concerns. So I'm glad that they've actually moved towards mutual funds and ETFs. That's a good thing.
So you think they've learned their lesson? The individual investor, they've seen the internet bubble burst. They've seen the great financial crisis in 2008. They've learned their lessons. In the future, though, do you think they're going to remember that? Or perhaps maybe they're going to learn that lesson somewhere in crypto or in sports betting, or it's going to come out somehow?
I think it actually happened in crypto. If you look at the big run up in crypto and then the big downfall in crypto, but we finally are getting some more regulation. I do realize that the Fed and the Treasury and the rest of people are not that thrilled with our moves into crypto. But I think that because it's becoming more regulated, more controlled, that people are going to have that advantage. And we might not see the big, gigantic moves that we've been seeing, but maybe something more steady, as a cryptocurrency probably should be.
People are talking about AI. We're going to be rewarding and awarding fund managers with nice statues probably this evening. Mm-hmm. Are we going to need those fund managers in the future because you have AI?
I don't. This is, I guess, old guy talking naively a little bit, but I really don't think you're ever going to replace that thought process. We've had quant processes in for quite some time, and they work great until they don't. And I think you have to have a knowledgeable investor. Do I think there will be a change in the fund space and investment space? Absolutely. But again, I think it will come hand in hand with human and also artificial intervention with each other.
Well, thank you, Tom, and congratulations on the 21st Lipper Awards.
Thank you, Greg. I really appreciate you guys being here. Not only that, I want to give a special shout out and thank you to you and Investment News for covering and being our long-term partner and for hosting and helping us run the Lipper 2024 U.S. Fund Awards.